Accounting 100, lesson number 5. Chapters 8 and 9 are included in this week's material. Chapter 8 discusses accounting for long-term assets, equipment, plant, and land. Current assets are also referred to as working capital. They are short-term and are consumed or turned over in less than a year's time. Long-term assets are used for more than a year before they are used up. Some assets, like land, have an indefinite lifespan and are never used up. Intangible assets, long-term assets can be tangible or intangible. Tangible assets can be seen and have a physical presence. They include property, plant, and equipment that are subject to depreciation. That is, as they are used and used up over time, with the exception of land. A second category is natural resources. Some, like lumber, are renewable. Others, like mineral deposits, are subject to depletion. Intangible assets can have a limited life or indefinite useful life. A patent has a definite length of useful life until it expires. Trademarks can have useful lives that span centuries. For example, look at the Coca-Cola trademarks. When valuing long-term assets, accountants use historical cost concept most of the time. Building valuation will include the purchase price plus sales taxes plus title and transfer costs plus realtors and attorneys' fees plus remodeling costs minus accumulated depreciation. Land is valued at purchase price plus sales taxes plus title and transfer costs plus realtors and attorneys' fees plus demolition costs of old buildings plus grading costs. Notice that all of these additional costs are used in making the asset useful and guaranteeing its actual transfer, as in the case of title. Land is valued at purchase price. We did that. Equipment and machinery are treated similarly. Historical costs are preserved in the accounts separate from depreciation allowances. Several methods of recognizing depreciation are allowed under GAAP. The simplest is called straight-line depreciation. The purchase price is divided by the number of estimated years of life, and that amount is recorded evenly each year until the asset is scrapped or sold. The depreciation is recorded in a contra account, separate from the book value or carrying value of the asset. When the asset is used up and discarded, any scrap value is recorded as a gain or a loss. If the asset sells for less than book value minus depreciation, we have a loss. These gains and losses are not recorded on the income statement as cash flows like regular revenue and expense flows, since they are one-time events. Thus, they appear under a separate heading as gains and losses in the investing section of a classified income statement. A second depletion method, or depreciation method, is termed a double declining balance. This is an accelerated write-off that reflects a higher cost of use in the early years of the asset's life and less in the later years. Under either method, the O asset can be depreciated below zero. A third method is called units of production depreciation. This is based on the estimated production of the asset for its entire useful life and recorded as the asset is used up annually. Since depletion expenses and depreciation expenses are not cash flows, they can be used to defer taxes from the current period as a result of the lower stated incomes. Since depreciation expenses are estimated, they are subject to revision based on shorter or longer useful life or on revision of salvage value. When accounting for expenditures on plant assets, some costs are treated as expenses, for example, repairs, and some are capitalized. This latter means that the value of the asset is adjusted by the amount of the outlay. Natural resources are depleted rather than depreciated. Hence, earlier I struggling with those two terms because in the script you will see the word depletion when we mean depreciation. Slight difference, but depletion refers specifically to natural resources. Trademarks, patents, copyrights, franchises, and goodwill are all intangible assets. Goodwill is treated differently from the others, and we know later on that goodwill is an accounting fiction that is used to balance the books when you pay more for a business than its book value. If a company has not purchased another company anywhere in its lifetime, then we don't worry about goodwill. It's after you've purchased another company that the concept comes into play. Chapter 9 covers accounting for current liabilities and payroll. The key operating concept of work here is called the going concern assumption. This means that the firm is expected to be operating and paying its obligations in full for at least the next year. Accountants are not allowed to project beyond a single year, by the way. This means that all liabilities are recorded at face value. We have already discussed promissory notes in earlier chapters. Other short-term liabilities include sales taxes, contingent liabilities, warranties, and payroll accounts. Each of these has its own peculiar twists that we will talk about in class. Payroll is especially complicated by a variety of mandated benefits that the employer must pay in addition to the base hourly or salary pay. Some of these are required by the federal government, some by the various states. If the firm is operating within the city, there may be city payroll taxes as well. For example, New York has such taxes. And this concludes lesson number 5. Thank you very much.